this recommendation for acquisition of up to 3 units.
Okay.
I second that motion. And the one thing, I second the motion, then I'll just make another point, not on the motion, because I support the motion.
It's been moved and seconded. All in favor indicate by saying aye,
I'm Rick Nelson.
and I will support 3.
Okay.
But
Thank you.
I also would hope that the staff would give significant consideration in the future to the issue and consult with the Commission on People with Disabilities, who has been exceedingly vigorous about this in the past, and engage in a discussion about the philosophy and the benefits, and can get some understanding of both sides of this issue. And like I say, I fully understand the administrative effectiveness of doing this. And I have great admiration and support for Jubilee. My remarks would have been the same with virtually any special needs population that was being addressed.
Okay.
This is just a presentation piece. On the very first slide, it presents four units that are shown in the opening. This one right here, yes. And those are not the 4 units we're talking about.
No.
Correct.
Okay,
No,
that's
so
kinda
that's really very. When I saw that out, I had one impression. Then we were talking about the properties themselves are not that. So don't leave with that. That's a misrepresentation.
Roy,
Well, we'll
Roy?
switch it to 3. Those previous 4 are more, background history.
So we'll revise the
And-
packet to, person with the comments that the commissioners have made, to give a little bit more background about the program and what we're trying to accomplish, so that it's a little bit more clear to the other commissioners as well.
And Roy, professionally, I was the realtor that helped them acquire 3 of those units. And the entire focus was to be in entirely different neighborhoods, and that they were already visitable, and went a long way to serving those persons, even who would have some mobility impairments. Short of wheelchair use, those homes were made quite physically accessible. So I'm deeply aware and deeply familiar with the needs and the organization, and I don't want my observations to be interpreted by anyone as questioning the desire and need. And obviously, the more efficiently they can operate, the more persons they can serve. So it's a balancing act, and I just happen to have strong feelings about this balance and the scatterization for any special needs populations.
Let me just pick up on a comment that Roy made. I think the reference to the 4 that we've already purchased with Jubilee, the specific reference needs to be absolutely deleted. There is no reason in a public document to picture them with addresses and
Yes.
identify them as special needs housing that is part of the program. I have no problem in terms of suggesting that we've done this before, but you can leave it at that. And the other piece, of course, and I think Roy hit on it very well, is you open this packet and you think it's about those 4 properties, and it's not. I mean, so anyway, change the packet.
Yes,
We-
please.
Can we move on?
Yes, let's.
Thank you very much.
The next item before us is Stewart Town Homes and the authorization to select a firm as tax credit investor and authorization of the executive director to negotiate and execute an operating agreement.
And,
Karine, I believe Zach and Gio or Gio.
mainly Gio for this one, Gio Cavalazzi.
Okay.
And Zach will discuss this item. You've seen previously a development plan which you approved, and previously a selection of a different tax credit syndicator. And for a variety of reasons, which Gio will discuss with you, we are changing course a little bit to for the benefit of this development. And we're selecting an alternate tax credit investor for it. And I'll turn it over to Gio, who will highlight the key points and answer your questions. Gio, please go ahead.
Thank you, Karine. Good morning, commissioners. My name is Gio Cavalazzi, Real Estate Division. And as Karine mentioned, we presented the final development plan for this Stewart Town Homes renovation and re-syndication back in November, December. And at that time, we mentioned that we're exploring an alternative tax credit investor proposals because the investor at that time, their terms had limitations that didn't allow for HOC to underwrite this transaction and take full advantage of it for HOC's interest. So we talked to several syndicators, received 2 LOIs, and which are presented in here, and we are recommending CREA LLC and asking the commission to authorize us to select them and to proceed with the negotiations of the operating agreement. So if we go to the executive summary slide, slide 18 in that packet. So these mostly is the same information you saw in the development plan, but towards the bottom, just goes over what I mentioned and updated transaction summary in terms of the sources of funds. The CREA proposes to pay 92 cents per dollar of equity. And R4, the other proposal we received, was at 88 cents. These are at, as a result of the legislative changes in December, we are now able to structure this transaction for 4% fixed applicable rate, which allows for a significantly higher tax credit equity to come in this transaction. And we'll see a source and uses table later on. So
just real quick. So commissioners, what that really means is that where we saw tax credit pricing into the early 90s, 90 cent-ish range, it was compensating often for a fluctuating rate, as Gio just pointed out. And so at this moment, the vast majority of syndicators are predicting that there will be a downward adjustment in overall pricing, but that a greater number of deals will actually get done as a consequence of that change, and the consistency adds to a greater level of quality and potentially interest even from tax credit investors. Now, all that said, new entrants into the tax credit market will be helpful in bolstering prices. And so, we're really kind of standing by to see what happens. But so far, we're seeing a downward adjustment into the high 80s in this market. There's still some that are into the 90s, but it's not this particular market.
So 4% credit transaction.
yes,
Yes.
4%, correct.
If it were a 9%, you would be seeing fireworks on the screen right now. We just, there's a fair amount of overlooking Montgomery County. I'm sorry, I was trying to think of the most appropriate word when it comes to 9%.
Thanks, Stacy. If we could go to slide 20, 2 slides down. This is a summary of the terms from the two proposals. Side by side, as you can see, mostly they are the same. The paying schedules are approximately same. The only major difference is the price, 4-cent difference. And for this transaction, for the size of the equity, each cent is worth about $111,000. So that makes CREA's advantage about more than $400,000 overall in equity terms. R4 did offer slightly sooner paying of a small percentage of the equity. But overall, even if we take into account the timing differences and the present value of that 5%, receiving that 5% earlier, it's just not enough to overcome the price disadvantage that R4 has to CREA. So, so for this reason, this is I think a easy recommendation to make. We're recommending a selection of CREA as the investor to this transaction. If we go to the next slide, I think that that gives you the information of why we went ahead with the replacement of the investor. So you can see here the CREA's offer and Boston Capital's offer that we had in our development plan. So Boston, like Stacy outlined here, Boston Capital initially had a 96-cent offer, but as Stacy said, that was at a fluctuating applicable percentage. And the way that the investors price these proposals is they allocate the losses from the future losses from the transaction, like interest expenses and depreciation expenses, et cetera, to the fixed amount of equity they're providing. And so if the equity amount is lower, as it was before, at a lower applicable percentage, the yield to the investors allowed for a higher pricing. With the equity amount actually going up, for them to maintain the same yield, they would have to adjust the pricing down. But overall, if we do lose a few cents worth of equity as a result of going to 4% fixed applicable rate, but with the amount we gain as a result of that, it far outweighs the loss of the equity as a result of the pricing. So, this to the right of this table, you can see the changes in the transaction as a result of going with CREA instead of Boston Capital. The biggest difference being that we are now able to underwrite a much higher level of senior debt, and this not only reduces the short-term debt we need to meet the 50% test for these transactions, but we can also lower the seller note amount in the transaction that HOC extends to this project. So yeah.
What is is the final figure from Boston Capital 88 cents? Is that their price? Because I see in this slide it says 96 cents.
Well, 88 cents was actually for R4's proposal now. So they were proposing 88, and that compares to 92 cents. This slide, what I'm trying to present here is the advantage. This is Boston Capital's previous underwriting that we had received back in March compared to now. So this outlines the reasons we decided to, delay the transaction closing slightly and change the investor in the transaction rather than continuing with the Boston Capital offer. So this is a comparison of the present underwriting with the past underwriting, and why the decision to go with the new investor that does not limit the senior debt size in the transaction is advantageous, and what it allows HOC to do. Yeah. But so one more thing to point out here, as Stacy mentioned, these 96.5 cents that Boston Capital proposed was again at a fluctuating applicable percentage. And we didn't ask them to reprice the deal at 4% fixed rate, but if we had, very likely their pricing would also come down. So the comparison, the advantage of the CREA offer would show an even bigger advantage in that case. So, if we move on to the following slide, I think yeah, this outlines the ownership structure, which didn't change, and you already saw this in the development plan. But the next slide um, summarizes the sources and uses of the transaction. And as you can see, it's mostly the same information. With our short-term debt requirement for the 50% test goes down significantly. The seller note also goes down. The one difference between the previous underwriting and this one is that there is now a bridge loan requirement that HOC has to fund. But we'll address this in the financing plan. It's just under $4 million bridge loan that we project. The following slide outlines the information that you already saw in the previous packet, so I won't spend too much time on this, but this just summarizes the HOC's plans for the property and underwriting the transaction at the level that the CDA requires. I think if we go to the next slide, I think, I guess one result of this change in the investor is that we were planning to close this transaction in February or March earlier. Well, these contributed to the delay, but it is not the only reason for the delay. We are also still expecting a 42M letter from CDA, and there are some other factors that wouldn't have allowed us to close the transaction in February anyway. But we are projecting the closing to occur in early June now, and the construction schedule and phasing stays the same. And we project that by the end of year 22, the construction will be finished, and a few months after that, we'll convert the transaction to permanent financing. And with that, our request again is to approve the selection of CREA as the tax credit investor, and request to authorize the executive director to negotiate the operating agreement with them.
This requires the board's approval, commission's approval, or just provide this for information to us as a committee?
We require approval from the commission.
It does require approval from the commission?
Yes.
I believe so, yeah.
Well, then I'm just trying to be clear about what the motion should be. I make a motion to support the staff's recommendation to recommend CREO as the tax credit investor for Stewart Town.
Second.
And moved and seconded. Any other questions of the staff? I'd just like to say I appreciate your re-examining and finding this more favorable opportunity, and I fully support it. And I guess for the record, all in favor say aye.
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 Thank you.
Thank you.
Can I offer a comment?
Sure.
And it relates to HOC's policy on replacement reserves. I mean, I guess we're technically complying with CDA's requirements. I'm not sure actually under FHA, what do they normally require for replacement reserves?
Karen,
250 per unit.
Per year?
Yes. Yes.
Well, I mean, my problem is that our replacement reserve gives us enough money to take care of ongoing issues and stuff that you don't really anticipate. But the fact is, because we're going to be the long-term owners, we know as experience has shown us, in 10, 15, 20 years, we're going to have to go through some major rehab. And replacement reserves is not going to at all help us in that regard. If I follow through the numbers on this, after 10 years, we'll have $5,000 a unit collected in replacement reserves. Double that, I guess, for 20 years, which means that we'd have to start almost at ground zero to get the funding necessary, which will be considerable at that time. And so in some respects, hog tying future commissions. And I know it's difficult to build a pro forma, operating pro forma based on increasing the replacement reserves. But we just are not going to have, a future commission is just going to have to go through this same issue of trying to identify where and how we can get significant equity and capital funds to do the job that's necessary. And I just think as a policy matter, we need to discuss it and or rethink it.
And you want, Commissioner, some level of history buttressed by obviously the numbers to be the floor of that discussion. Yes. Basically, you want us to take a look at what we've done in the past,
well,
and sort of bring it forward.
I mean, if I'm the only one, if I'm the only one who's concerned about it, that's fine, and you don't have to worry about it.
No,
I just think as a matter of policy and planning, we ought to think about whether we seriously think that minimum requirements by funders notwithstanding, is this sufficient to provide some kind of cushion for the commission at the time they have to go through some major renovations? And if it is not sufficient, is there any alternative to helping them? Or are they just going to have to be on their own to find the big bucks?
So, all right.
I mean, that's an oversimplification of it, but that's sort of where I'm coming from.
I get the gist.
So,
And I'm not asking you to spell out what you do. I just think you need to.
I think it's a matter of the definition of what we're talking about in terms of replacement reserve. Because and I understand the point you're making, Rick, but if you were trying to build that into the pro forma in terms of being in 20 years out of having sufficient money to rebuild without a major refinancing, that way you'd never build anything.
Okay. I agree with that, Roy, but is there a way that you can at least have sufficient monies that the equity requirement in 20 years could be possibly better satisfied than it is right now? We don't have anything built in really to address the equity. I know we're going to have to refinance.
Right. Let us huddle, because I mean, part of it, just real estate, fundamental is that there's the latent equity is generally what you're relying on to buttress it. But I mean, I understand your point, right? Because we never know where we're going to be in that moment of time. We never know what the financial markets are going to be, and to put that entire burden on a future commission, a future staff, given that the property is a going concern, anything we can do to mitigate that would be helpful. So yeah, I think it's a good point. And
but I guess the latent equity is, I understand that, and I guess sort of part of the problem there is, as the continuing owner, we're not able to tap into all that latent equity to support our share of the financing in 20 years. That's the problem. I don't know that we can't address that because it's the way it is in terms of financing, but I just want to see if there's a way for us to better prepare the commission to be able to bear that burden of having to share the HOC cost of refinancing.
Yeah, I think it's a valuable consideration. I think the thing about the assets that we own is a building, and so often what happens is that by the time you get to a point where you've got to refinance a building, enough investment has not been made to keep the building in such a substantial position that they realize the full equity value of the asset. You know what I'm saying? And so we've got to figure out a way, because that's the biggest thing we have really at the end of the 20 years is having a great building that's still in great condition and in fact could be refinanced again and you can garner out and take out all the equity that's been built in because you've got still a substantial asset. I think that's really what we want to try to do. Because that so often does not happen, especially when you're talking about affordable housing. And the thing that's always concerned me about replacement reserves is that in a lot of our buildings, when we get to a major systems need, there's not enough money in the replacement reserve to even cover a major system replacement, okay? And so then that is the downside of the building, your asset depreciating, because you're not being able to capture the full value of the building because we haven't maintained the building. So you got to keep the envelope. So I totally agree. There's a way to do that. You should think about it.
Okay.
If I could just,
Item on a future agenda.
Yeah.
I think Gio had something to say.
oh, no, I was, I understand what you're saying, Commissioner Nelson. I guess addressing that through the replacement reserves would affect the NOI and affect the transaction at present. So it may be not the best way to address that concern through the replacement reserves, but that can be addressed some other ways because capturing that value at present would be affected if we were to.
I don't care how it's addressed. I just think that somehow we need to figure out a way to address it, because right now the system for long-term affordable housing owners like us doesn't really provide us the vehicle to do it.
Yeah, and what we've done in one of the recent transactions, I can't remember which one, but I think it was Green Hills. We had two components of the replacement reserve, in that we had a portion that was included in the operating expenses as a must pay. And then we had, so as not to curtail the amount of the debt that we were able to raise, we put a portion after NOI so that we're funding two parts of it. So we'll look at it, and Zach and I have started to talk about, as we're presenting these transactions to you for consideration, to create a template where we're looking at the physical need and looking over the years at systems replacements and things like that, and how the reserve gets used.
Okay.
And try to answer your question: is 5,000 per unit at year 10, is it enough? And if it's not, how do we get to what we think is enough? And what does it mean for operations as well as for the impact to the agency? And come up with a reasonable response to what we know is important to the commission. And it may be that we can get there or that we can't, but at least we'll tell you, and that's up to the commission to make a decision on a project by project basis. And that's the best we can offer right now, and it's a discussion point that will be ongoing.
Okay, no, that's all I asked. That's good, thank you.
Okay, are we ready to move on?
Sure. And the next item.
Carrie, 1 second. Do we have a vote?
Oh,
I thought
Yes,
we
we did.
did.
Yeah.
Yeah.
Well,
Okay.
We did it. We did it.
Yeah, we did, because I waited until after the vote to
Yes.
raise my point.
okay. So the next item is related to this Stewarttown discussion. It is about Stewarttown, and it is amending the finance plan to reflect the changes to the development plan, which Victoria Dixon in the mortgage finance area will review with you. So Victoria, handing it off to you.
Good morning, commissioners. So, as mentioned, revising the financing plan to recognize the changes being made in the amended development plan. The new LIHTC investor, including a ask for the new bridge loan of up to 4.6 million and a resulting increase of the volume cap and bond authorizing resolution by $500,000 for this transaction, for a revised amount of 16.5 million. The Previously in January, the commission approved the final financing plan, which totaled an estimated $38.1 million, which contemplated the permanent mortgage loan, tax exempt construction to perm, backed by FHA risk share, up to $16 million to be funded by the issuance of bonds, the LIHTC equity, the subordinate seller's note of up to $12 million, and contemplated assignment of the existing county loan to the new entity. The mortgage loan under the previous LIHTC investor was restricted to a maximum of 11.7 million or $125,000 per unit. With the new LIHTC investor, the current underwriting for the transaction now assumes a permanent mortgage of approximately 15 million can be supported at a 1.5 debt service coverage using an all-in interest rate of 3.369%, inclusive of a cushion against rising interest rates. The increased sizing of the mortgage loan of approximately 3.4 million reduces the short-term bond and seller note needs for the transaction, as shown in the updated sources and uses. Should interest rates hold and the cushion be removed, sizing of the mortgage loan could increase further. Due to revisions of the scheduled availability of sources, the transaction is projected to require up to 4.6 million of bridge financing until repaid from the receipt of the LIHTC equity installments. Staff proposes to utilize short-term taxable draws on the PNC real estate line of credit to fund this bridge note with a maximum term of up to 30 months from closing. With respect to the volume cap allocation and bond authorizing resolution, the transaction will also require sufficient volume cap to fund a bond debt service, a reserve equal to 6 months, estimated at approximately 320,000. When combined with the revised short-term bonds and long-term bonds being issued for the transaction, the total volume cap and private activity bonds required exceeds the existing $16 million allocation. Therefore, we are requesting to increase by 500,000 to our revised 16.5 million. The amended bond authorizing resolution will also correct the name of the bond series being referenced. Will the Development and Finance Committee join our recommendation to the Commission? Are there any questions?
One
Any comment?
point I would make, in these proposals where we're talking about using the line for bridge loans, I assume that somewhere back in the office you are doing a timeline of what we're borrowing, what we're paying, and all that sort of stuff, like we do with the OHRF. But you don't make the definitive statement in here that yes, it is possible in terms of the ins and outs of that fund that we can manage it.
So there are covenants on the RELOC for what we're permitted to use, and those were evaluated assuming the use for this transaction to make sure that we would not.
Yes, we're tracking it, Commissioner.
Okay,
Yes, we're tracking it.
thank you. I would move support of the staff recommendation.
Is there a second?
I second it.
I then call the question. All in favor of moving forward to the commission, the staff's recommendation, indicate by saying aye.
Aye.
Aye. We're unanimous.
Thank you.
Thank you.
And I believe that was the last item on the agenda.
Yes.
Today.
Is there a motion to adjourn?
So moved.
Second.
We are hereby adjourned.
Thank you.